Hi there, and welcome to Safe Option Strategies. Welcome to our presentation on collar trading for low risk and high reward. My name is Jeffrey Dunyan. I am the owner and the founder of Safe Option Strategies. And there's a good chance that you found this class after listening to one of our other videos where we gave a very broad general view of what we do at Safe Option Strategies, the way we teach collar trades, and the way we teach trade adjusting for spread trades to put together a way of trading the markets that is absolutely incredible from the perspective of incredibly low risk and very high potential rewards. In the other class that you may have seen, we didn't take the time to get into detail on how collar trades can become incredibly profitable trades. And so what I'm going to do with this presentation is just a little recap of how a collar trade works. And then I'm going to focus on a couple of real examples of how we made some phenomenal profits using collar trades, because the number one reason we do collar trading is because of the low and oftentimes zero risk scenario that we can set up. But profit trades can be quite profitable. And that goes against the grain with what most places teach and with what most people will tell you. If you were to just look up the definition of a collar trade, you would find that it describes a trade that has very low risk but a very small potential reward. And the way we collar trade and the way we adjust collar trades, that's simply not the case. Let me go through a very, very quick recap. A collar trade is primarily a way to buy stock and then use a long put option almost exactly the way you would use an insurance policy with an asset. The long put will go up in value as the corresponding stock goes down. So if you were to buy some shares of a stock and then you were to buy a long put option to go with it, as the stock price goes down in value, the long put will increase in value and offset the loss of a stock. And that's a very simple protective way of being in the market and not putting everything you have at risk. And in honestly every way you can imagine, a long put option with stock ownership works like an insurance policy would work for your home or your car. Now, when you add to that a short call, a covered call, and chances are, if you've done any stock and option trading, you're probably very familiar with what a covered call is. Someone else in the market is going to pay you some money for the right to buy your shares of stock away from you, but only if those shares of stock go over a certain price. Well, that money you get paid from that other person can, in many cases, offset partially or completely the cost of the long put. So the setup of a collar trade works like this. And again, we're just going to recap this quickly because I want to focus on showing you where the profit comes from. You buy a stock. This is a ticker symbol for Snap, which is the parent company of Snapchat. At the time we took this screenshot, the stock was trading at, whoops, I advanced that too quickly. The stock was trading at 17. Stock was trading at $17.98 a share. There we go. I couldn't get the pin working. We could get that short call, that covered call, to pay us $1.75, and then we could pay $1.52 to insure the stock. And with a total cost per share of $17.75, we maintain the right to sell at $18 a share, and we have a zero risk trade. These are some other examples that we showed. Target, TGT is the ticker symbol. We could have a trade that's $120 a share and only have 17 cents at risk. Under Armour, $7.97 a share to be in the trade and the right to sell at 8, zero risk. Micron, $45.53 to be in the trade, $46 per share is our strike price of our long put. The right to sell there gives us a zero risk trade. So where does the profit come from collar trading? Every one of those trades that I just showed you, and you can rewind and pause and look at those and analyze them any way you want. Every one of those trades has a period of time, and that's between now and the expiration of the long put option that we add to it. Just like when you buy an insurance policy, you pay for it a year at a time or you pay for it every month, and that's the duration that you're insured for. Long put option works the same way. So every one of those had low to zero risk for a period of time. And the question then becomes, where does the profit come from? Well, many of you have heard of what dollar cost averaging is. You buy a stock for a certain price. Let's say we buy a stock for $100 a share, and that stock goes down to $50 a share. So we've got 1 share times $100. And then when it's down here and we think it's reached a bottom and it's going to go back up, we have 1 share times $50. So our total investment is $150, and we're going to divide that by 2 shares of stock. Our average cost is 75. Dollar cost averaging is something that's been done since the U.S. stock market first opened. You buy low when you have the opportunity to offset the average cost per share of some of your shares that you purchased a little bit higher. We don't buy these 100 shares thinking that the stock is going to go down, but we never know. And if these last few months haven't been an indicator of we never know, nothing else is going to convince you of that. So the concept of dollar cost averaging has been around for a long time. But when you add what I just showed you with the collar trade, you get the stock and then you go out and buy a long put. So now in essence, you've got that stock insured, that $100 a share stock you have insured for $100. And you're going to pay a couple dollars for the long put. So your average price per share is $102, or excuse me, $102. $100 per share of stock, $2 per share for the long put option that goes with it. Now if the stock drops, at the time that stock drops, instead of having to find that other $50 to be able to buy that next share of stock, you're going to sell the long put. And that's the primary difference. In the first scenario that I showed you of dollar cost averaging, it's a great concept to lower the average price per share of your stock, but somewhere in your portfolio, you've got to have that extra $50 per share to add those other shares of stock. When we do a collar trade, we don't have to come up with that other $50 a share through some other means. We come up with it by selling the long put for the $50. We bring $50 into our account, and then we send the $50 back out of our account to buy that next share of stock. And now we have one of those shares times $100, and this was $50 in and $50 out. So now we have another share that didn't cost us anything. Now we've got a total of a $102 investment, because don't forget, we had to pay for these long puts. We have a $102 investment divided by 2 shares. Our average price per share now is only $51. You see the difference? In the scenario without the long puts, we could dollar cost average that down, but by doing so, we got the price down to an average of $75 a share. So when this stock begins to recover and come back up after a 50% loss, it's got to have more than a 50% gain just to get back to where we would be at a break even. That's with just the dollar cost averaging that takes us to $75. With the long put option included, when that stock goes back up, it's profitable at $51 and a penny. At $75, where we needed the stock to get break even in our first scenario, this one is now 50% profitable. And if that stock ever got back up to the original $100 a share we bought it at, we would be nearly 100% profitable in this trade, instead of just being back to break even or being a little bit profitable. This is where the profit comes from in collar trading. I'm going to show you in detail 2 examples, and then I'm going to show you quickly several other examples of how this works. I had a student a few years back that shared with me that he had gotten into JCPenney. Now, if you watch the news and you pay attention to what's going on, JCPenney is in Chapter 11 bankruptcy right now. If someone doesn't come along and buy that company, JCPenney, a company that I grew up with, I had a Sears catalog and a JCPenney catalog growing up. It's going to be gone forever if someone doesn't step in and buy it. So here we've got JCPenney. Now, I don't know that I would have chose JCPenney. And if you don't notice anything else on this chart, notice that on the far left of it, this is about the time this student of mine got into JCPenney. And do you notice at the end of this chart how far down JCPenney is? It took a big drop. Now, it had a lot of ups and downs in between. But here's how he made money collar trading. I want you to also keep this in mind. His original investment was only $4,350. And doing exactly what I just showed you in the dollar cost averaging with long puts, here's what this student of ours did. He had JCPenney protected going into an earnings, and when that stock dropped dramatically, he was able to sell those long puts, and it gave him enough money to add 400 shares to his position. Stock had a nice climb back up and got close again to an earnings report, so he put a collar back around it. He added new long puts to it, repositioned his short call to help pay for those long puts. JCPenney took another nosedive. He was able to leverage into another 300 shares just off the profit of his long puts. At this point in time, he had enough money from those long puts to probably get 365, 370 shares, but there was a little bit of cost of the long puts that he wanted to offset. So without increasing this investment at all, he added 300 more shares of stock. He repeated the process over the course of the next almost 9 months. That's a 9-month stretch of time right there. He repeated that process and was able to add another 400 shares. When he saw the stock after this 400 shares he added right here, keep in mind, still hasn't increased this original 4,350 investment. He did not have to go find other money somewhere from his checking account or his savings or his portfolio to add these shares of stock. It was all coming with no added investment, strictly off the profit of the long puts. When this stock finally got back up to a decent price, a little over $9 a share, he had increased his number of shares from 300 to 1,400. And at $9 a share, his $4,350 investment was $12,600, or 182% in 18 months. More important than that, during this entire 18-month period right there, he had zero risk. He always kept things positioned so that the next time the stock dropped, he wasn't going to lose any money. He repeated this process several more times before getting out of the trade. Let me clear my marks off of here. And after 3 years and 4 months, he was up 475% on a stock that was down more than 30% from where he originally bought it, and had been at times down much farther than that. This is where the profit comes in collar trading. I'll show you another example. We got into Under Armour with our students. This isn't something that a student of mine did separate from our company. We shared with every Safe Option Strategy student this trade. Getting into Under Armour shares, we saw a little bit of growth in the stock. We got a collar put on it. When it dipped, we were able to add a couple hundred shares. We repeated the process. And I want to point out, I'm giving you the Cliff Notes version, the short version. There were several adjustments that were made during this time. We had to roll long puts a couple times. We had to roll short calls a couple times. But we added a big chunk of shares over this period of time. And even when the stock had only got back up to $21.39, we had more than 3 times, almost 4 times the number of shares, and a stock that was trading down almost 50% that we had 100% return on. Now think about that, a stock that's down 50%, and we were 100% profitable on this trade. One that we did more recently, a short period of time later, we were 100% profitable right here when it got to 21 and some change. On that last dip and that last addition of shares, when we got back up here, we were almost 200% profitable. A more recent trade we did just towards the end of last year, we got into some shares of Twitter. And this is kind of what a collar trade would look like set up on a stock chart. We bought the stock when it was right up in this range. We got long puts right at the money, and we got a short call. right at Twitter dipped down a little bit, and our long puts were going up in value, and our short calls had paid for them. So we were pretty much break even going into their earnings report at the end of October of last year. And I want you to look at what happened. This next screen I'm bringing on is 3 days later. 3 days ago, Twitter was right here. 3 days after their earnings report, Twitter was down here. And all the while, our long put had skyrocketed up in value. As that stock price plummeted, our long put shot up in value, and we lost no money. There's the zero risk scenario, and I just showed you a great way to make profit. I could show you example after example after example of how we have collar traded companies and made incredible profits in not very long periods of time. 280% growth in 20 months on Netflix. Best Buy, collar trade we did on Best Buy over a period of time. You ready for this? 171% growth in just 2 years. Snap, I showed you an example a little while ago of how you could get into a trade like this. $351% growth in 24 months. Folks, there's a lot of information on our website. There's a lot of information about how we trade and how we help people become very, very profitable. As you probably already know, we offer a complete education on how to learn how to collar trade. We offer a complete education on how to learn how to spread trade. And most people will end up combining these two courses and learn all the benefits of trading with incredibly low risk for incredibly high profits. You're welcome to explore the website as much as you want. If you want information on any current promotions that we're running for these programs and for these courses, fill out the form that's right below this class, and we'll get back to you as soon as we can. Thanks. Have a great day.